He'll probably jump on in a second. Here we go. Hey, what's up, man?
Hey, Jonah, can you hear me?
Yeah, can you hear me?
Yeah, we're loud and
Yeah.
clear, man. Sorry, I misplaced the link there for a second.
Oh,
I
no
was
worries.
lost in the webs.
So this is a little out of the norm for me. Normally, I'm interviewing CEOs of publicly traded companies. You're kind of the first industry guy that I've brought on, but
Okay.
I've made a ton of money on shipping stocks this year. I know you have as well. Obviously, others have. And I just don't think a lot of retail investors understand the opportunity in shipping, or maybe the easy money, and this probably is true to a certain extent, maybe the easy money has already been made and the upside isn't necessarily there anymore. But I just want to kind of dive in. I mean, so I own ZIM, right? Ticker symbol ZIM, and I am no shipping guru. I mean, I track the indexes, the Baltic Dry Index, and what's the other big one? I'm losing the name right now.
Are you looking for containers? It'd be the Harpex or the
Yeah,
Contex.
Harpex.
Okay.
And I mean, when you've seen the indexes go 8x, 10x over the last 15, 16 months, it just became clear to me that some of these shipping companies were going to start printing money and then have to return that capital to shareholders. So that's why I got into ZIM. I'm still holding it. I've trimmed the position a couple times, but I still think there's more upside because you look at the free cash flow and how they're going to distribute that to shareholders next year in dividends or buybacks, or who knows. So that's kind of my take on it. I know you follow the whole industry. I know you have other thoughts on ZIM as well as some of the other ones. So, real quick, just kind of give us a background on yourself and how the hell did you get into the shipping industry?
Yeah, sure, absolutely, Jonah. And first off, are we recording? Are we
Yeah,
live,
we're
or is
recording. Yep. Yeah.
it like a live stream or something? I
Yeah, I
can
mean,
retweet it.
yeah,
Or...
I mean, some people will watch it live, but most people just wait for me to post it to my YouTube channel.
Okay, fine. Yeah, I'll share it to the folks on our research page and
Okay.
retweet it and do all that kind of stuff whenever the recording is ready. So
Okay.
Perfect. So, anyways, Jonah, thanks for having me on here. It's good to talk with you. I've noticed some of your trades in the past, and I'm glad we could intersect here. I'm a very fundamentals driven guy, a little bit maybe longer term than I think you do normally. I don't want to.
I mean, I'm still long term, but I'll trade around positions, or I'll take trades on a nice technical setup, as a 2 or 3 week hold. But most of my positions, at least my core positions, are meant to be 12 plus months.
Okay, so we're aligning here with that core position in that time frame. So yeah, I've been involved mostly on Seeking Alpha as a blogger, first of all, way back in 2011. So I've been there for 10 years. But about 2015, I launched an exclusive research service called Value Investors Edge. And that's where people sign up and they can pay either per month or per year to become a member of that service. And that's where we put 90 to 95% of our content. So if you see stuff on Twitter, stuff on Seeking Alpha, that's kind of the 5 or 10% tip of the iceberg. And after we've kind of developed an idea. So ZIM kind of fell into that, and as far as how I got into shipping, look, I mean, a guy like me, I don't have an edge, being humble. I don't have an edge in something like Apple or Tesla or Microsoft. Right. Like, I mean,
there's 50 analysts that cover those companies, and like rarely they're going to give you an opportunity to make like shipping, right? Not very many people follow the shipping industry. So you have a chance to get in before the big money does, right?
Yeah, not a lot of people follow it. There's only a handful of analysts, and the stocks trade all over the place. I mean, they don't always. I had a couple of dings on me on Twitter recently. They're like, "Why the hell do you waste 10 years of your life doing fundamentals and shipping? They don't matter." Like, well, they do matter if you're getting ahead of the curve and you're looking at which companies are good and which companies do I avoid. So fundamentals do matter. They just don't matter on like a 1 day to 2 day to maybe 1 week basis. So if you're a trader, it's good to have the fundamentals in mind, but maybe they're not the most important thing. But if you have a 6 month, 12 month, 2, 3 year type of time frame, which is kind of how I operate, and it sounds like you do as well, then those fundamentals definitely matter.
And they can say shipping doesn't matter, but I'm looking at ZIM right now, and ZIM was a $10 stock back in January when I believe they went public, and today it hit $60. So 6x in 9 months is hardly anything to sneeze at.
No, absolutely not. And ZIM was just a remarkable IPO. So I imagine we're going to talk for a few minutes and we can do more of the background of ZIM and how that one happened. But just for disclosures up front, I trade actively and invest as well. I am long my core position of ZIM shares, but I also trimmed some recently. I actually sold a bit at $60 flat earlier today. I also have some short-term hedges. I was kind of expecting a secondary. I've been wrong so far. They haven't done it. So good for them. I mean, good for the Nous Corp. And
yeah, I mean, I know. So I saw people talking about that on Twitter. I mean, when you say a secondary, you're not talking about ZIM issuing new shares to raise capital for the balance sheet. You're talking about some of the strategic insiders getting out, right?
Absolutely. So it has no impact on the valuations. It has no impact on long-term investors. All it is you got two unnatural holders in the stock. You've got the Nows Corp, which was also a big favorite of mine a while back, DAC.
Okay. Yep.
I think it's been a 17 bagger year over year. I wish I could tell. I bought a few thousand shares at 505 last year. And I wish I could tell you I held all those shares to 85
I mean,
bucks.
I did the same thing last year too. Last year was so strange. I mean, I was buying stocks at 50, selling them at 100, thinking I was a genius. And then 3 months later, they're at 200.
It's like, man, but nobody, there's that old saying, nobody ever went broke taking a profit.
No.
Right. So these are good trades, but
a lot of the stocks have given you a chance to get back in at lower prices. Yeah. So, but like you said, I mean, you got to take profits along the way. You can't let positions get, too large for your risk tolerance. And I mean, we know all that stuff. How is DAC different than ZIM?
So the big thing here with ZIM is they are leasing in their ships, right? They're asset light. So they're really owning these ships. They lease in their tonnage and they commit to, 2, 3, 4-year charters, and they're dependent on the freight rates. So think about your packages going to UPS or FedEx, the stuff that goes into Walmart, Target, Amazon. That's ZIM's business. They're actually moving those packages across the world from China to US to Europe, and that sort of thing. Danaus Corp owns the actual boats themselves. So they're more of an asset heavy company, and their only thing, it's like really more of a financial company than anything. I mean, they own the ship, they have like a mortgage on it with the bank, and then
they lease it to companies like ZIM.
Exactly. So they're more stable. Right now they're exciting because the Harpex, which is actually the index for ship leasing, the actual leasing of those vessels, is on fire, right? So Danaus Corp is just printing money. And they're a lot safer in a way because they got 3 or 4 or 5-year deals. As long as the liner companies like ZIM, like CMA CGM, like Costco, as long as they don't go bankrupt, which they're not, right? I mean, how would they do that? So as long as they don't have financial difficulties, Danaus is a money printing machine. ZIM's a little more exciting though, right? Because you can pick up the freight rates and watch those skyrocket. Right, so ZIM gives you,
because they're locked into lower lease prices, like their cost, right? Yeah. And then they've watched the shipping rates skyrocket, so they're able to charge more to these larger customers that are moving products around the country, around the world.
Yeah, they're at the end of the whip. They have the most operating leverage. So you think about the companies like ZIM, they're the most exciting right now because as the freight rates go up and up and up, they're getting basically 100% of that goes to free cash flow. I mean, it's very exciting. Then kind of the middle of the whip is the ship leasing companies like the Nows Corp, Global Ship Lease, GSL. I'm long that one. That's one of our favorites. They're kind of middle of the whip. And then the more stable, safer, longer term, I'm talking to you buy it for 3, 4, 5 years, is stuff like the box lessors. They're really kind of a boring business, but they actually own the metal boxes. And so that's like the safest, longest term play. And then ZIM is like the most exciting put your cowboy hat on kind of play.
Right. So there's all these different like levels of risk in the shipping industry based on what their business model is.
Exactly.
Now, will this eventually catch up to ZIM in the future as these contracts expire and they need to lock in new contracts?
Yeah, so that's kind of the risk, and that's kind of, I guess, the bear case against ZIM is that as their charters expire on these ships, they have to pay more and more and more for the vessels. And you can see how much they're paying by looking at the Harpex, right? And you can see what their revenues are by looking at something like the Shanghai Containerized Freight Index, SCFI, or the Freightos Freight Index. You can Google these and see these basically for free. I think they're a week delayed if you don't pay. But I mean, that's pretty good data.
I pull them up on like Y charts.
Yeah, so I think it's a week old, but I mean, hey, that's pretty good data. So, and they're free. So that's the freight rates. So ZIM is playing the spread. So kind of the risk or the bear case to ZIM is that, look, if freight rates fall off a cliff in 6 months and the ships are still tight, then the spread, it's like WeWork, right? The spread goes down and they're kind of stuck.
Are we seeing any rollover on the pricing?
The freight rates, no. The freight rates have just skyrocketed. In fact, I was wrong. I've been very bullish, ZIM, you know this, but I was actually wrong. Back in April or May, I said, okay, we look a little toppy on freight rates. I still love ZIM, but I don't think the freight rates can go higher. My God, I mean, they've more than doubled. Yeah, they've more than doubled. So very happy camper.
So I owned a company called Atarian and I got killed on it because, their whole business model is manufacturing in China and shipping over to the US and then selling on Amazon through their FBA. And when I saw their Q2, and I thought it would be a bad Q2, I didn't think it would be that bad. And as soon as I saw how they got smoked on shipping rates, I doubled my position in ZIM. And not that I didn't make all the loss back, but at least I made some of it back. And then when ZIM reported a couple of weeks later, I mean, they smashed it out of the ballpark. They raised guidance for Q3. They raised guidance for full year. And you see a company like that, now they have a $7 billion enterprise value. Back when they reported, it was like $6 billion, and they were going to generate over $4 billion in free cash flow this year.
Yeah.
I don't think I've ever seen a company generate 60 to 70% of their enterprise value in free cash flow in a year. It's insane.
I've never seen, IPO usually stands for, it's kind of a joke, but it's probably overpriced. Right. Warren Buffett coined that. ZIM is the first IPO I've seen in my entire life where it was insanely underpriced. And I was looking at the prospectus, and this is way back. This was in January when the prospectus came out.
Right. So the pandemic was still going on. Like, is that why they did it?
Correct. Well, the thing about ZIM is they've been like a 40-year-old company. They're a long-term company, but the stock is new. And the reason the stock is new is they got in trouble after the global financial crisis a decade ago. They were overextended. They had way too much legacy debt. They kicked the can down the road for many years, and eventually they went bankrupt, basically. Okay. And this was back in like 2011, 2012, 2013, those kind of years. And it was a long, drawn out restructuring process. And so then the company was private. It was actually mostly owned by the Insider family, which is the Ofer family, and Deutsche Bank, a German bank. So that they were the big holders, and the Danaos Corp had a share as well. And so that was private for like 5 or 6 years. And eventually, Deutsche Bank wants to cash out. Yeah, they want to get out of it. And Danaos Corp kind of wants out. So that's why the IPO happened. They didn't need money. I mean, business was good. It's the only IPO. Well, I don't want to say the only IPO, but one of the only IPOs where they didn't actually need or really want the cash. They just wanted to get the shares to market.
They just need some liquidity for these strategic investors.
Exactly. I think Blackstone, I don't know if that's an old story, but Blackstone was similar. It was like this ass-kicking private equity company that just wanted the insiders to be able to cash out. And the same kind of thing. They didn't even want the cash. They just wanted a listing.
So the thought is that the secondary would come from Deutsche Bank and Danaos that want to take their capital out, but those shares are already outstanding shares. They're just not floated.
Correct. So there's no, if you're a long-term investor, and I'm talking 6 months, 12 months, 2 years, 3 years, like there's really no impact from this. This is just me being kind of cute. And I've been wrong so far, but this is me kind of being cute a little bit and saying, well, if Danaos Corp and Deutsche sell 10 million shares, it's probably going to go, what is it, $60 now? It's probably going to go to 55 or 52. When I started thinking this, ZIM was like 54-ish. 54-ish is when I started putting on some hedges. Something it's 54-ish. If they do a secondary, it might be 49. Right. So, it's not going to be a big deal, but it could be a short-term like choppiness.
You can't blame them when the stock's up 6x since the IPO. I take profits in my portfolio, so why shouldn't they take profits in theirs?
Absolutely. And analysis cost basis is like $1 a share.
I don't really follow any of the other shipping companies. Is it similar for them? Are they all making this much free cash flow, or not to the extent of ZIM?
Well, ZIM, like I said, it's kind of crack of the whip. So, you're getting all the operation leverage. So ZIM's probably the most exciting. We're talking 1.6 times earnings or something.
It's insane.
Yeah, it's crazy. So they're not all that cheap, but Danaos Corp was one I was pounding the table on a while back. And this was about 2 or 3 months ago. I put out an article, and Danaos Corp was $55. And I'm like, hey guys, this thing's been an 11 bagger for me. I'm actually more excited and more bullish on a risk reward sense at 55 than I was at 7 or 8. And here's why. And I list out all the reasons, but basically they're trading at 2.5, 3 times earnings, and they're locking in all their ships for 3, 4, 5 years. So not only do they trade cheaply, it's almost like guaranteed cash flow, right? With ZIM, I like ZIM, I'm on long ZIM, but with ZIM, there is more future risk, right? We don't know what 22 and 23 and 24 are going to look like.
And that's the problem. When you look at the estimates for 2022, it shows, and I haven't looked in a few days, but a 25 or 30% drop off from this year, because the analysts are assuming that rates are going to come down, but we really don't know at this point when or how much rates do come down, right?
That's correct. All we can do is guess. And I've been wrong. I'm probably the most bullish person on ZIM, or at least I was a few months ago, and I've been wrong. Like my targets have been exceeded. So it's been a wild market.
Now, how do you think these companies are going to distribute the cash to shareholders, right? So if ZIM does 4.2 billion in free cash flow this year, Do you think they're going to buy back stock? Do you think they're going to do a special dividend? Are they going to, I mean, I know they just exercised an option the other day for some new ships. Are they going to invest in more ships? Any thoughts?
Yeah, no, that's a really good question to focus on. They have an official policy of 30 to 50% of net income is paid out as a dividend. And they've reiterated and reaffirmed that they're going to keep doing that. Now, I think when they set that policy up, I mean, they're keeping their word, they're going to honor it. But I think when they set that policy up, they didn't think they were going to pay a $15 dividend. Yeah. So there's going to be a massive dividend from ZIM.
I mean, you're talking like $20 a share, 20 to $30 a share, right?
Well, the earnings are going to be about $30 a share. So the 30 to 50%, I'd say probably 13, 14, 15, $16 somewhere. That's a massive dividend.
Oh yeah.
That's like
on a $60 stock, right?
Yeah. I mean, 25% yield in one punch. And that's probably coming, it's going to come after Q4 results because they have to see what they've earned. So right. Probably like March, I would say February or March. Repurchases, I don't know. They've been kind of lukewarm to those. I think if we're 70 or 80 or $90, I don't think so. But I think if there's weakness and we fall back to 45 or 50, then yes, that's kind of how I see it. It's kind of a spectrum.
Okay. I mean, because ZIM just came public, I mean, we really don't have a track record, right, to see what the stock might do in anticipation of a big special dividend. So we don't know if the stock would run up into it or not.
Yeah, that's correct. And we also don't know, what people's tax positions are. It's not that nasty. It's not nothing to really freak out about, but it's an Israeli company. So right. There's a different tax withholding rule on that. And so basically I can't give tax advice. I'm not a registered tax advisor. See your CPA, right? Boilerplate. But basically you want to hold those shares, generally speaking, in my opinion, in a taxable account, because you're going to take that Israeli withholding tax, but then you can net that against your US obligations. So there's basically very little impact. But if you hold it in like an IRA or 401k, you might want to call your tax advisor and have them help you out a little bit.
Now, I've heard, so on some Q2 earnings calls, not just from stocks that I own, but also some companies that I'm looking at, I heard CEOs saying that, container rates were 4,000, pre-pandemic, and now they're 25,000, right? That's accurate?
Yeah, I mean, you have to see what they're talking about. So there's all these different metrics. So the metric most people look at is TEU, like a 20-foot equivalent unit. So that's kind of like the short boxes. And so, but some people talk about FEUs, which are 40-foot equivalent boxes. So it's just important to look at the index and see what they're talking about. If you think like a railroad car, they have the boxes on them. Sometimes they're double stacked. Yep. Those are 40-footers.
Okay.
The 20-footers are kind of like, sometimes you see a railroad car and it has like the little, oh, that's a cute little box. Those are the 20s. So when you talk about rates and you see the really big, like 24,000, 22,000, it's usually a TEU, 20-foot equivalent. And then for the FEUs, would be half. So, 11,000, 12,000.
Okay.
So he's probably talking TEUs then.
I mean, was there any way for companies to hedge the risks, coming into this year? I mean, I know most people didn't anticipate these rates going up so much, but I mean, you've seen companies, especially smaller ones that were relying on their manufacturing, supply chain in China. I mean, they really got smoked by these higher rates. Could they have done anything to hedge better?
Well, one thing they could have done earlier on is they could have negotiated more long-term contracts. And traditionally, the liner business has been really bad for like 10 years. So a lot of these shippers were getting kind of a free ride, or they were getting like an artificial market. And they thought it was the real market, but it was really artificial because there was such an oversupply of ships and oversupply of liners. So they got kind of lazy, and they took shipping for granted. But some of them were a little smarter and they signed more long-term deals. And I think we saw Dollar Tree, DLTR. That was a recent short of mine into the Q2 earnings, and it turned out pretty nice on the short side. But that entire short was predicated on the fact that they were misallocated of shipping, right? Like they hadn't anticipated it correctly. However, on the Q2 results, they had their come to Jesus moment. And they're like, look, we've paid up. We've learned our lesson. We've chartered more ships. We've done more long-term business. So I think Dollar Tree in 2022 is going to be smoking the competition because they took the pill. They took the medicine. Home Depot, they were ahead of the curve. Kudos
Didn't Home Depot like buy their own ship or something? I heard some crazy story.
Yeah, it's kind of nuanced and complex. They don't actually own it. Like it's not Home Depot. They don't have the orange vest on the ship. Home
Depot across the back.
Yeah, so it's a little more complex and financial. But yes, basically they own all the capacity on one ship.
Yeah. Holy smokes! I was going to ask a question. I forget what it was. Oh shit.
Well, it brings up I'll just throw in a funny story then.
Yeah.
While you think of that, I try to be friendly on Twitter, and I have 12,000 followers, and I try to respond to everyone with tweets and stuff. But sometimes, I'm having a little fun or getting a little snarky. And this is late June, and I'm sitting on, huge ZIM profits, big container ship profits, dry bulk profit. I'm having a good year. I'm having a good time. It's Friday, probably a few beers too many deep. And some poor guy who runs a small shipping business in the United States, and he's on Twitter, and he's got he says, "Oh my God, it's $10,000 to ship a box from here to here. Like, I can't believe it. I'm getting screwed." And it has this tweet has 1,000 likes and 400 retweets. And I'm like, oh God. So I'm like, I respond to him, and a little too many beers and a little too snarky, but I'm like, dude, you can bitch about shipping or you can profit from it. And I listed some tickers, and so not, I guess the moral of the story is that I'm an asshole, but no, the moral of the story is that people can play the market a little bit.
Oh,
people
yeah.
can hedge, people can take other sides, and you figured it out, right? You're like, one company's getting their ass kicked.
Yeah, I mean, now granted, I lost 6 figures on Ethereum, but I made half of that back on ZIM.
Yeah, and because you figured out, you're like, well, this story's going to ass kick, so let me get the other side of the trade over here.
Exactly.
And hopefully, fingers crossed, but hopefully ZIM makes more, 2 or 3 or 4 times that money back, right?
So I know a question I was going to ask. So a lot of industries are regulated, right? Whether it's financial services. I mean, I've been in hotels before, and actually on the back of the door, it actually tells you what is the max rate that the hotel can charge. So I feel like almost any other industry in the world, if your electricity, if your local, electric company tried to jack up your rates 8x, some government agency would step in and prevent that from happening. Is there no limit as to how high these shipping rates can go before some government agency jumps in and was like, okay, guys, that's enough. You are crushing companies with these rates. Why hasn't that happened? It just almost seems unfair.
Yeah, no, it's a great question. And that was kind of a big fear that came out in I think it was June and July when the Biden administration started focusing on this a little bit more. And just a quick note on the electricity prices. I have to ask the people in Texas about that one, right? That was the one exception where the electricity prices were insane for a week. But
I mean, I remember back in, Hurricane Katrina, when gas prices skyrocketed, you drive by a gas station, every 5 minutes, they'd be out with putting new prices up. So
yeah, it was insane. It was out of control.
Insane. And then I think finally, the government had to step in and be like, okay, enough with the price gouging.
Yeah. I mean, and that was just disaster. I mean, that was just predatory and gross, right?
Yeah,
and
for sure.
I mean, there's stuff like that with COVID, with people hoarding hand sanitizer. And
but this almost seems predatory too.
I mean, you have to zoom out a little bit and look at the structure of the market. And there's all sorts of different ways you can look at this. There's actually monopoly indexes, like the FTC, the Federal Trade Commission. Whenever companies want to merge, they pull out this thing, and I'm probably going to butcher it, but it's called the Heffinger-Ollinger Index or something. Okay. And there's actually a score that they can do. Yeah, and they plug in. They're like, how concentrated is this market? And the higher the concentration, the worse, right? It's like a monopoly, right? And container shipping on a global basis is extremely competitive. It's very fragmented. There's even we talk about consolidation, but even with the consolidation, you still have 5 or 6 or 7 players that are serious competitors and make up a serious portion of this. So it's not quite like AT&T and Verizon, where there's only 2 big players. It'd be like AT&T, Verizon, T-Mobile, and 6 other companies. But for some reason, Spectrum went out of sight, right?
And I guess they wouldn't be charging $25,000 a container if someone wasn't willing to pay it.
Exactly. And the problem
that's
here,
supply and demand at its finest, I suppose.
That's exactly what it is. There's too much demand for these goods, and there's not enough ships to carry them. It's not artificial. I mean, every single ship in the world is working. Right. I mean, every single container box.
And they're full. And now, are there still ships sitting in ports that are unable to get in, or it's just a slow process?
Yeah, so that's actually happening right now again. The LA and Long Beach are hitting record levels of congestion again. And that's because we're hitting the seasonal peak. We're at the peak season right now. It's the pre-holiday stock up. Right. And this happens every year. I mean, it's every year from about late July to about early November. And that's just the hottest of the hot every year.
I mean, it's our fault for making all of our shit in China.
Well, yeah, I mean, you could argue about supply chain security and
it's finally like exporting all of our manufacturing to China is finally coming back to bite us in the ass.
Well, I think that's a good point. I think we have reaped the benefits for 15 or 20 years straight, and now we're paying our taxes. I mean, that's really what it is. And another thing that we've messed up as a country is we have not adequately invested in our ports. We have not adequately invested in our supply chain infrastructure.
Right.
We haven't invested in automation because the labor unions have been against it for 10, 15 years. So our ports like LA, Long Beach, Oakland, Seattle, Tacoma, a lot of these ports are kind of embarrassing compared to like the ports they have in Singapore or China. We're like way behind the curve.
Yep.
Yeah. So that's a problem.
Like during the pandemic, I mean, you see those pictures of just like dozens and dozens of ships just sitting out there waiting to come in.
Yeah, absolutely. So we have this big infrastructure bill, right? And there's a lot of politics around that, and it's tied up in the House somewhere. But they allocated, I think it was like 45 billion to ports.
Wow.
And I'm like, about damn time. I mean, this should have been done 5 years ago. I mean, the ports are way underinvested.
What is Long Beach the biggest port in the U.S.?
That's the biggest port in the United States. Yeah.
Okay, because that's where everything comes in from Asia.
Yeah, that's correct. It's LA and Long Beach. So it's two separate ports, but one like governance vehicle, like because it's in the same region. And then Oakland, which is only 100, 200 miles away. So those 3 ports in California are basically like 75% of the West Coast right there.
Okay. I mean, just out of curiosity, stuff that's coming out of Mexico, I mean, does it ever come through ship or is it always coming up through trucks?
Very rare because there's pretty good rail lines that connect Mexico to the United States. So depends. I mean, I don't want to say there's not, because I mean, there definitely are, but most like Mexico US trade on, I'm kind of going off memory here, but I think a lot of it is refrigerated stuff like agriculture products.
Gotcha. Yeah. And what about, what's the largest port on the East Coast where stuff from Europe would come in?
So the biggest port authority on the East Coast is New York, New Jersey. The Port Authority of New York there, and in New York, New Jersey. And then there's also a big port in Savannah and Charleston. There's actually like 12 ports along the East Coast there.
Have those been as much of a clusterfuck as the West Coast has been?
So they've done a lot better. And I'm actually a PhD student. I don't know if you knew that, but one of my research projects has actually been looking at the difference between the East Coast and the West Coast ports and what's going on there. Because the East Coast has been smoking the West Coast for the last 10 years straight. And there's a lot of factors that play into that. And they are a little congested, right? Because the demand is so high, but they're handling it a lot better. And there's a plurality of reasons behind that.
Interesting. So other than ZIM, and I know you still have a position in ZIM, would you say ZIM right now is your favorite shipping stock, meaning the most upside over the next 6 to 12 months?
No, I wouldn't say that at this juncture. We're recording on September 10th, 2021. Right. It's about $60. Right now, today, I wouldn't say it's my favorite. I'm definitely long. I'm definitely bullish. Now, if you would have asked me, I mean, this thing moves so damn fast. You would have asked me like 2 weeks ago, Jonah, I'd be like, absolutely, let's do it.
I got in. I forget. I've been in for probably 5 months, but I doubled my position as soon as I heard the Ethereum news, and then I increased the position again after they reported earnings and I saw the new guidance come out.
Yeah, that was huge.
So it's now I think it's now a top 10 position for me.
Yeah, no, it makes sense. Yeah. And look, I mean, I cover 55 companies or follow 55 companies on Value Investors Edge. Yeah, they're all, I stay in my lane. So they're all like maritime shipping or energy related. But so when you ask me, is it my favorite? Well, I got to look at the list of 55 and I got to see all the upsides. And, so it's not the favorite, but it's certainly a member of my model portfolio. So it's in my top 10 for sure.
How many different categories like inside of shipping is there? Because I know there's dry bulk and there's like iron ore and like oil and liquefied natural gas. Like there's a whole bunch, right?
Yeah, you basically nailed them. There's 6 broad categories. You can probably go more granular if you want to, but you have 2 types of tankers. You have crude oil, dirty tankers. You have the clean tankers, which are products, gasoline, diesel, that kind of stuff. So 2 types of tankers. You have the dry bulk that you talked about. That's iron ore, coal, that kind of thing. Container ships, which is what our discussion is about today. That's all the retail goods. And you have 2 different types of gas. Well, there's more than 2, but the 2 main ones are LNG, natural gas, and LPG, which is basically propane.
Okay. Yeah.
So each segment, right? I mean, I gave a presentation. I do these like quarterly webinars. Like I said, about 90% of the stuff is on Value Investors Edge, about 10% or so is public, but about once a quarter, I do a webinar and I try to bring, that free for everybody because I realize not everybody can afford the research and I want to be helpful. But each quarter I do a webinar. And so, it's on YouTube now, actually on my profile page. You can see it for free. I posted about 5-6 weeks ago. All that information is relatively current. I mean, these cycles move in 6 months, 12 months, 18 months. So it's not like I'm giving you some worthless video here. But I talk through each of the cycles, or the main cycles, and I pick kind of a favorite in each category. So that might be helpful to folks that are on the podcast today and want to check it out later.
So ZIM, container ships, that, you know, they've been very strong. Have those other categories been as strong this year?
Yeah, I mean, in different ways. So tankers has been struggling because that's the one area of shipping that really got screwed by COVID, because they are very dependent on the marginal barrels of oil that are consumed. And all that marginal barrel of oil is basically like jet fuel and diesel and that sort of thing. And so until the global airline travel comes back,
Gotcha.
we're not really going to see a big recovery in tankers. However, dry bulk, which is, you know, iron ore, coal, that kind of thing, that has seen a robust surge in rates. We're at 11-year highs. Container ships are all-time highs.
Right.
You know, I mean, these are wild rates. And let's not, you know, these aren't going to be here forever. I mean, this is boom time. And you make hay when the sun shines. That's what we're doing. We're making our hay. But, you know, dry bulk is at 10 or 11-year highs. But in 2007, 2008, the rates were 3 or 4 times higher than they are today. So that suggests to me that if dry bulk gets a little bit more compressed, it could blow up again as well.
Now, when would the ideal time to get out of some of these container ship companies? When would it be? Before, you know, prices start to roll over, or, you know, if prices come back 20%, are these companies still going to print enough money to, you know, to justify more upside in the stock?
Yeah. Well, let me figure that out exactly, and then I'll tell you after.
Right. No. I mean, that's what I'm trying to figure out. I mean, I have no idea where prices are going to be for all of 22. I mean, prices could stay this high for the next 6 months and then start dropping. But, you know, if you average them out over the course of the year, maybe ZIM does another $3 billion in free cash flow next year.
Yeah, no. You're asking the right question. I was being a little facetious, of course, because everyone's trying to figure out when we need to exit, right? And we all exit at once. It won't work out nicely. But no, there's 2 things to look at: one quantitative and one qualitative. So the quantitative side, for a numbers guy or whatever, is to look at what the cash flows are and look at what the earnings are and look at what the balance sheet says and say, you know, does this make sense, right? So like with ZIM, they're going to do 30 something in earnings this year. I would say anywhere from like 30 to like 34, 35 is FY21. FY22, I don't know for sure, but I would say somewhere around 10 to 20. It's a pretty broad range.
You think it could drop that much?
I think it's going to come down. I would say somewhere between 10 and 20 is probably reasonable, which is down. I mean, 15 bucks on the midpoint. Right. I mean, the stock trades at 60. So like, but you look at these and you say, okay, they're going to do, you know, let's say 35 this year. They're going to do 15 next year. That's 50 bucks in earnings in like a year and a half, right? And the stock trades at 60. So that means I'm buying the entire rest of this business, which is like debt-free, by the way, for $10. I mean, I'm buying an annuity, 10 bucks. Does that make sense? No, it's too cheap, right? But if it gets to the point where it's like, okay, earnings this year, earnings next year, oh shit, I'm paying 100 bucks for this annuity. I don't know, right? So that's quantitative.
Right.
Qualitative.
It's just funny because you look at the 10-year treasury at, you know, under 2%, and then you do like, you know, what's the earnings yield on a stock like this? And you're like, why would anybody buy the freaking 10-year treasury when you can just buy ZIM and have them return a third of your money back to you every year in a dividend? Like,
yeah, I mean, at these current rates, it's unbelievable. So that's the quantitative side. The qualitative side is when you have people, you know, broadly, I mean, like people who never been interested in shipping before, broadly, like, these rates are amazing, but not only are they amazing, this is the new paradigm. This is the new normal. So not only is ZIM doing 30, 35 this year, I think they're going to do 35 forever.
That would be scary for the global, you know, consumer companies.
Yeah, it would be bad for the global economy. It would be a bad thing if that happened forever. But then you say, okay, well, they're going to do 35 this year. I think they're going to do 35 forever. 35 is the lowest they'll do, you know, like that's some crazy talk, right? And then, oh, I'm going to put a 10 times earnings multiple or a 15 times earnings multiple. Therefore, ZIM's worth $350 a share. That's when, you know, I'm like, okay, guys, like we're off the, you know, we're a little bit off the boat here. So that's what I look at.
Even if ZIM traded at 60 bucks for the next couple of years, but returned, you know, 30 bucks to you in dividends, I mean, you still have a hell of a, you know, total return story there.
Yeah, I think that's true. And that's why the way I look at it, and we look at it Value Investor's Edge, is we have fair value estimates. And those are, you know, subjective and they can change over time. But the fair value estimate, the way we look at it is basically the same way you look at it. How many dividends are we going to get? How high are the earnings? What's the residual value? And those fair value estimates change. So my fair value estimate that I put on this company about 6 weeks ago was $65. And then, correction, $60 before earnings. And then after earnings, I bumped it to 70. So right now we're still at 70. But I think as the rates keep staying higher, that 70 has a lot of upside in it, right? But right now at this point, my personal target based on what we've discussed is $70. So if it hits 70, am I going to sell? Maybe not, but it's a marker in my brain, right? It's a number that I have that keeps me grounded.
Yeah, I mean, we're at 50. Yeah, 50. I didn't trim any today because I did trim 20% of my position a couple days ago in like, I don't know, 56, 57 range. I mean, this has just been bonkers, but I mean, it's well deserved. I mean, I don't think I've ever owned a stock in my life that was going to generate 65 to 70% of their enterprise value in free cash flow. Like it's just such a unique story, an unprecedented time. Obviously, the pandemic had a big part of this. If we hadn't gone through a pandemic and the supply chain had not been disrupted like this, I mean, where do you think prices might be right now on containers? And then ZIM might be a $20 or $30 stock right now?
Yeah, I think if we didn't go through the pandemic, but we still had, a healthy economy, right? Yeah. We're not talking depression. We're talking like 2019, 2020, pre-COVID, right? I think ZIM could justify a valuation somewhere in the range of, I don't know, maybe 25, 35, $40. So that's what I think about when I talk about those dividends plus residual. I'm like, well, the residual ZIM in like a normal world is probably worth, I don't know, 35, $40 somewhere in there. How much excess, right? I mean, this is like free money. How much free money am I generating in the near term? And look, we're doing $35, 30 to 35 is my estimate for this year's earnings.
Yeah. I mean,
and that's a lot of extra money.
Like even right now, consensus for this year is $31 a share. Mm-hmm. And then next year it drops down to just under 10. Yeah.
So I think the 31 and that 31 is very recently updated. I don't know if you have a chart that shows you what the previous, like those 31 people are late to the train.
Oh yeah. Oh, no doubt.
Because if you look at consensus, Jonah, it's pretty cool. If you look at consensus back in like July, for this year, it was like $21 or $20.
Yeah, if I go to usually if I go to Koifin, I can see the change.
Yeah, it's pretty remarkable. So I think the same kind of thing is probably going to happen in 2020. Like you said, $9, right? Was consensus. I think that's
for next year, $9.50 right now.
Yeah, I think $9.50. I think $9.50 is way on the low end. I would say, and I'll try to be pretty balanced. I'm not going to make up some BS number, but I think somewhere between 10 and 20.
So on ZIM, back in March, it was under $11 of earnings.
Okay.
And then it's like basically stair stepped up. And now it's at, is that earnings? Yeah.
Yeah, I think I have the same thing. I think I have the same thing as you. I'm on Seeking Alpha, but I think it's the same data. Yeah, it was like, if you go back to July, it was 1877.
Or is that, I'm looking at short interest now. Hold on.
Yeah, I think I have it on my screen. It was 1877 in the end of July. So that was only 2 months ago. Right. It was 1877, and now it's $31. So I mean, the consensus has came a long ways, right? 22 consensus was 616 in July, and now it's 955. I think 955 is still way too low. So I think we're going to see upside in that consensus. I think 31 is probably a little bit low. I think maybe I said 30 to 35 is my personal estimate. So somewhere in there.
Do prices typically increase through the holiday season?
Yeah, so the demand for shipping is usually the highest between July and about November. So we're kind of at the peak of the season right now. Well, maybe in a month we'll be at the very peak. But look, this congestion is going to take more than a few weeks to run off. I mean, we saw what happened last season. I mean, there was congestion big time. Remember, it's like December, January, February, there's congestion. We didn't get through it until like June. So if there's this huge congestion in say like October, November is like the peak. We're not going to get done with the congestion until like March of next year. Oh, and then when we get to March, it's time to think about the next Christmas. So like it's a vicious cycle on that.
So when might we get a like any indication of if or when prices are going to start coming down? Would it would be after this peak season or after the congestion?
Yeah. So if you go to like the Freightos or the Shanghai Containerized Index, which I mentioned, I think, look, and Joan, I've been wrong. In May, I was like, hey guys, I think the rates are peaked. So keep in mind, I'm kind of conservative. People don't think so because I'm like really bullish at shipping. But if anything, I'm kind of conservative in rates. I think the rates are probably going to peak around mid-October-ish because that's kind of the peak of the holiday season. I guess where they peak. Now, I don't know where, what number that might be. It might be a number that we won't even believe. But I think that's the top. And I think the the true moment, or like the moment of truth of to whether this is sustainable or whether or not it's just like a short-term thing, is around the Chinese New Year. So that's the Lunar New Year. That's basically the start of February. So I think the start of February is like your litmus test. You're like, are the rates, are they $10,000 or are they $3,000? And if they're 10, I mean, this party is going on. I mean, if they're $10 in February, or $10,000 per TEU in February, ZIM's like a $200 stock.
Wow.
If they're 3,000, then ZIM's probably a $50 stock. So that's kind of your litmus test.
Now, is the problem all coming out of China, or is it the same thing out of like Taiwan, South Korea, like, and then are companies going to use this as an excuse to start moving manufacturing out of China, or doesn't it matter because rates coming from that part of the world are going to be high no matter what?
So the disruptions are kind of two-sided. So there's the export, like port dislocation disruptions, and those are almost all from China. Like the kind of overbearing on COVID. Like there's like one case at the ports, they locked the whole thing down for a week.
Yep.
That's kind of the supply side is from China. However, the import disruptions are heavily in Western Europe and the United States, and that's because of underdeveloped ports. We haven't invested in the right equipment. We haven't done enough automation. We haven't put enough, frankly, we just haven't put enough money into our ports. And we're finally starting to do that with that infrastructure bill. But those are big projects. Those aren't going to be done until like 24, 25.
Who are all the ports owned by? Are they owned by the state? Are they owned by some government agency, or are they privately owned?
Each one's a little bit different. So I don't want to give a broad sweeping answer, but it's basically a government sanctioned kind of project. Like it might be a corporation, but it's like, it's kind of almost like sometimes like utilities, like power companies and water companies, right?
Gotcha. Okay. I think that's all I got. We miss anything? I know, I mean, you could probably talk for a lot longer about shipping. I don't want to overwhelm people.
Yeah, no, I think it's always good to keep things a little limited. I think it was a great discussion. I think, if there's something else crazy that happens in the next, I don't know, few weeks or few months that, you remember when the Suez Canal got jammed up, the ship got stuck in it. So that was a thing that like most people didn't quite understand yet, like how important that was. But that was an event like Value Investor's Edge, like that thing happened and we're like, oh my God, we need to double down on shipping.
Now that impacted shipping from Asia to Europe, right?
Correct. But because of like the ripple effect or the domino effect, it impacted basically shipping rates globally.
Because those ships that would have offloaded in Europe would have then picked up more stuff and brought them to the US basically?
Something like that. I mean, I don't know each ship has its own, voyage and all that kind of thing. But basically it was only, a 4 or 5 day blockage of the canal, but those effects reverberated for months.
It seemed like 2 weeks from all the crap that was going around on Twitter with memes, but it was only 4 or 5 days. It honestly seems so much longer than that.
Yeah. Well, it's kind of like that saying, like if a tree falls in the woods, does anyone hear it?
Right.
And so I think at that point, people were making memes and people were laughing about it, but I don't think people actually thought, how can I make money from this?
Right.
Right. They didn't really trade it well. So if that happens again, Jonah, let's talk. And I'm sure we can have some fun with it.
So we've talked enough about ZIM. Before we go, what are like 2 or 3 other shipping stocks that you're really bullish on for the next, let's call it 6 months?
Yeah, that's perfect. I'm glad you asked. You asked me earlier, what was my favorite idea if it was ZIM? And I said, well, it's top 10. One very closely related idea to ZIM that I think folks that understand ZIM would understand this one is global ship lease, GSL.
Okay.
And I've talked about that one publicly a few times as well. And when I wrote that big article about the Nous Corp, a lot of people just bit off on the Nous, but it was actually, hey guys, my ideas are the Nous and global ship lease. They trade, I want to pull them up so I'm not making up numbers here.
This one's been a monster too. So I mean, right around when ZIM got to 35 and now it's at 60, this one was about 15. Now it's at 23. So it's moved about 57% in a month and a half.
Yeah. So GSL has been a very profitable stock for me. So, but the thing with GSL is remember how I mentioned like ZIM is kind of crack of the whip, like the most operational leverage. Yep. GSL is kind of in the middle. So they're doing 3-year, 4-year, 5-year deals with their vessels. Their earnings are not going to be quite as eye-popping as ZIM, right? So it's not quite as exciting on earnings. Maybe you talk about $8 or $9 or something.
Do they own their own ships or are they leasing them?
They own their ships and they lease them to people like ZIM. Like ZIM would be like one of their clients, right?
Gotcha. Okay.
But the thing with global ship lease is when you value a shipping company, you look at something called NAV, net asset value. And you can adjust that asset value based on the charters and based on the contracts and based on the debts and that sort of thing. Normally in a good shipping market, you expect your stocks to trade around NAV. Maybe they're a little bit below, maybe they're a little bit above. We expect it somewhere near. GSL's NAV is almost $60 and it trades at 24. So, our current fair value estimate is $40. So if you take 40 over 24,
Wow.
public math.
And then another one you've talked about is NMM.
Yeah, so NMM, Navios Partners, very bullish, that name. However, caveat, dot, red alarm, like management concerns, governance concerns, it's a little bit risky. It's people sometimes call trading, shipping, they say it's like a trading sardine. NMM is a little bit more of a riskier sardine. GSL is something I'd be happy to own for several years.
I mean, I think the shipping industry definitely has a reputation of being a little kind of shady and sketchy to begin with.
NMM will live up to that reputation. I'm long the company. I'm long some call spreads. I like NMM. I think they have huge upside, but I have to warn people, like, be careful with that one. It's a little bit riskier. I'm long it, of course. And then we mentioned GSL, and then one final one is in tankers, because I know we mentioned tankers briefly. Tankers are kind of boring right now. They're not doing very well. But once we get past COVID, tankers are going to go off pretty crazy.
Meaning when travel demand comes back and people are flying again.
Yeah. So this is one that you buy kind of slow and kind of quietly, and you kind of sit on it and you wait for 6 months. We as traders, investors, we don't like to wait for 6 months or 12 months. But if you have patience and you can wait for 6 months or 12 months, I really like International Seaways, INSW. That's a tanker company.
Okay.
Yeah, it's headquartered in the United States. I know the CEO and CFO personally. They have great corporate governance. It's not like one of those risky, some shipping you say that has like a bad reputation. This is a very well-ran shipping company. It doesn't have
so this one hasn't had a big run up like the others, obviously.
No, it's because the market's not very good. Right. The market sucks. But when the market's good, I think that could easily be a $30, $40, $50 stock.
Okay.
So that's a long-term one. Put that on your whiteboard.
Yeah. It's on the watch list now. Well, Jay, thank you so much, man. Really appreciate you coming on. This was excellent. I learned a lot. I mean, come back in a couple months if we get any new developments or container prices keep going higher. You want to come back and laugh about it with me, feel free.
Outstanding. Thanks again, Jonah.
You got it, man. Talk soon. Bye.